Last week, the Federal Reserve increased the federal funds rate by 75 basis points, the largest single increase in the rate since 2004, increasing its benchmark rate to 1.75%. The move was widely expected by global markets, and the Fed has already signaled its intention to continue to raise interest rates in an effort to get inflation under control. But the move raises a number of questions about what exactly is going on in the US economy and in the broader global economy, and what, if anything, the Fed can do about it. Hey everyone, I'm Noah Zerbe. I'm a professor of global politics at California State Polytechnic University Humboldt. Welcome to IR Explainer, where I explore the concepts and theories behind current events in global politics. Let's start with the unusual conditions in the US and the global economy right now. The United States is currently in an unusual economic position. Inflation is at high levels, currently hovering around 8%, while the job market is relatively tight with historically low levels of unemployment. Jobless rates are currently around 3.5%. This combination, high inflation and low unemployment, is not particularly common in U.S. history. The last time the U.S. saw inflation above 8% and unemployment below 4% was 1951. Since 1948, monthly unemployment rates have been below 4% 146 times, but over the same period, inflation has only exceeded 8% 15 times. According to the former U.S. Treasury Secretary Lawrence Summers, every time in the past 75 years when inflation has exceeded 4% while unemployment fell below 5%, the United States has entered a recession within 2 years. This includes periods in the early 1950s, the 1960s, the early 1970s, and during the 2007 global financial crisis. This is part of the reason why many economists have been urging the Fed to take stronger, quicker action to get inflation under control. And the Fed seems to have taken note. The Federal Reserve Chair Jerome Powell has backed away from suggestions the economy may hit a soft landing, getting inflation under control while retaining a strong labor market, and now agrees that a soft landing target will be really difficult to hit. Why is that? Because the primary tool the Federal Reserve has to get inflation under control is one that slows the economy down, and higher rates of inflation will likely necessitate more dramatic moves and thus be more punishing to the economy. The federal funds rate is the rate that banks can borrow money from the Federal Reserve. This rate is the benchmark rate for most other interest rates across the economy, from housing, car, and student loans to commercial and consumer credit to interest rates on credit cards. Put simply, when the Fed increases its interest rates, the cost of borrowing for everyone goes up. If inflation is being driven primarily by consumer demand, increasing the cost of borrowing should, at least in theory, reduce that consumer demand and bring inflation down. But the cost of bringing inflation down is often paid for with increased unemployment. Indeed, the Fed's goal of getting inflation down to around 2%, the historical rate of inflation in the US, at least since the 1980s or so, would likely entail accepting a higher rate of unemployment, somewhere around 4 or 5%, a level the Fed has historically viewed as acceptable. The other concern centers on what's driving inflation in the first place. The Fed's traditional model of the economy places low unemployment at the center of the explanation. The argument is essentially that a tight labor market reflected by low rates of unemployment drives wages up. Employers pass the higher wage costs on to consumers through higher prices, thus generating inflation. This trade-off between inflation and unemployment is reflected in the Phillips curve and has historically played a central role in monetary policy interventions in the economy. But there may be reasons to believe that the current period is different from some of the historical periods of inflation. First, the sharp increases in government spending during the COVID crisis may have been inflationary, quickly injecting large sums of money into the economy without corresponding increases in productivity that would have mitigated against inflation. Relatedly, during the COVID lockdowns, many consumers reduced spending and increased savings, deferring vacations and other discretionary purchases. When the lockdowns ended, consumers who had delayed purchases were anxious to return to normal, generating a sharp, sudden increase in demand for everything from vacations to weddings to cars and a host of other items, and generating a sudden increase in prices. Third, the supply chain disruptions caused by the pandemic itself reduced the ability of producers to meet this sudden increase in demand. Remember that in the simplest terms, inflation is simply too much money chasing too few goods. Disruptions to the supply chain meant that producers could not quickly respond to new demand, and as a result, inflation increased. Many economists who were analyzing inflation earlier in the year placed a strong emphasis on these COVID-related factors, leading them to conclude that such inflation would be transitory in nature, dissipating as COVID-related and COVID-delayed spending declined. But the war in Ukraine complicated this situation, leading to sharp increases in global energy and food prices, both of which are central to increasing inflation. Food and energy are not like most other consumer items. While individual consumers may reduce purchases of most items as prices increase, food consumption tends to be relatively less elastic than most other items, and demand does not decrease quickly as prices increase. Similarly, energy, particularly fuel prices, tend to be stickier than prices for most other commodities. Because fuel is needed to transport goods around the world, increased energy prices tend to become generalized in higher commodity prices across the board. As a result, the fuel and fuel commodity prices that spiked as a result of the war in Ukraine may be driving some more generalized inflation increases in ways that the Fed may be less able to address. So what's the future? The Fed has already suggested that it expects to continue to raise the federal funds rate for the remainder of the year, likely increasing the rate to somewhere around 3.5% by the end of the year. This means that we should probably expect another 175 basis points increase in the federal funds rate over the remaining 4 scheduled Fed meetings this year. All of this has led to sharp increases in the value of the US dollar, which has reached record levels against most other international currencies following the Fed's move. This is because the higher interest rates in the United States tend to increase demand for dollar-denominated bonds. But increased dollar values tend to be bad for the balance of trade, as it makes imports into the United States cheaper, thus generating demand for more imports, while simultaneously making U.S. exports comparatively more expensive and thus less competitive in foreign markets. And now there's reason to be concerned that the U.S. could enter a recession, defined as a period of at least 2 consecutive quarters of negative economic growth within the next year or so. If that happens, the Fed could face even greater pressure to act, though its room for maneuver could be seriously limited by inflation. This is because the primary tools the Fed would use to avoid or to come out of a recession tend to be inflationary themselves. In this sense, we could be witnessing a return to the stagflation crisis of the 1970s. That's it for now. If you found this helpful, click the thumbs up button and subscribe to catch future explainers as I release them. Please leave any questions you have about this video or any suggestions for future explainer topics in the comments section below. Thanks for watching, everyone. Bye.